Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to cover a topic that is a question that we receive pretty much on a weekly basis as to which one is better, trading debit spreads or credit spreads. And many of you that have traded options have probably either wondered the same thing or may have read certain things that lead you to believe one way or another. Or maybe you have learned that certain conditions are great for credit spreads and other conditions are great for debit spreads. So today what we're going to do is we're going to review both strategies, understand fundamentally what is the difference between the two, because I really think, to be perfectly honest, it's not even a matter of which one's better. It's a matter of when is the right time to use each one, because one is not better than the other. I promise you, if there was a strategy that is better than the other, everyone would only trade the one that's better. No one would trade the one that's worse. So today, what I want to do is explain what the difference between the two are and clearly give you an understanding as to what is important to decide which one do you use for your trading. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the securities that we're going to discuss here today for reference purposes. So I'm going to start off by just giving everyone a brief overview of vertical spreads before diving into the difference between credit spreads and debit spreads. And for those of you that have traded with us for a while, you're probably familiar with both. But what we are going to do is really dive into truly the differences between the two that are going to be important for us to pay attention. And then what I'm going to do is spend a bit of time on the option Greeks. This is something that we don't really spend a lot of time on when we talk about vertical spreads, but when we look at the Greeks on these vertical spreads, it'll become very obvious what you want to spend more time focusing on in terms of selecting between the two. And it's going to be hopefully very obvious for investors once you look at the Greeks. Then we'll talk a little bit about the trade management of each one and how they're different, before taking a look at risk management, which is the same across both strategies. And then we'll talk a little bit about how you can find some opportunities using the reports that we send out to OptionsPlay members before looking at some examples here for Q&A. But the primary question that I want to help investors answer from today's session is, how can I decide if I should trade a debit or credit vertical spread on the opportunities that I see here in the broader markets? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And over the past 16 years as a market strategist, I have received this question over and over again. Which one is better? When do I use each one? And I tend to find that there's some information out there that isn't quite lining up with the data as to helping you select the right one. So that's why I wanted to do this session and clarify for everyone what is truly the best strategy to use depending on each scenario. So before I jump into this, how many of you have a preference on strategies? Do you have a preference? Either type in credit if you prefer to sell credit spreads, type debit if you prefer to buy debit spreads, or type no if you don't really have a preference. You can bring up the chat window at the bottom of your screen. Okay, I see quite a few no's. I see some debits. I see some credits, but a lot of no's. Okay. I usually tend to find that a lot of people prefer one over the other. I will say, while I don't prefer one over the other, there is one strategy where people trade more than the other. Okay, so I see a lot of responses, and there's quite a few on both sides, but I would say probably the overwhelming consensus is that people don't necessarily have a preference over one or the other. So let's just discuss, first of all, what a credit spread is. It's a fairly simple strategy. It's a limited risk strategy and a limited reward strategy, which makes them really simple to understand. So especially if you don't understand them, once you learn them, it's really easy to kind of grasp, right? Because most options strategies, some of the more complex ones, make it difficult to understand as to what your potential risks and rewards are. But with vertical spreads, you know exactly what you're going to get. You know what your max risk is, what your max loss is. However, there is one of these two strategies, debit and credit spreads, that's generally used 3 to 4 times more frequently than the other strategy by investors. Now, Why is that the case? Well, there's going to be a few reasons that I'm going to show you as to why one strategy is used more frequently than the other one, even though it's not necessarily better than the other one. And then what we really want to, and the strategy is really, both strategies provide you with a way to potentially profit from a directional view. The question is just whether your directional view is a very strong one or more of a mild directional view, whether you think the stock is going to drift in a specific direction or you think the stock is going to fall apart and move in a specific direction. So today, we're going to explore both strategies and make sure you understand the difference between the two. So I'm going to use Ford here for an example, and I'm just simply using this for educational purposes. This is not a solicitation to look at Ford in a bullish or bearish way specifically. I'm simply using Ford because it recently broke out from a major support of resistance level around 13.5, broke out, traded all the way up to 16.5, and now we're back to this support level. So viewers, you can have different views on this. It doesn't really matter what your views are at this point. What we're basically saying is that what if this bounces off this support level and continues back towards that 16.5 level? And the question is really dependent on whether you think this bounce is going to be a quick and fast bounce back to that 16 level, or do you think it's going to be more of a slow grind? It might maybe spend some time moving sideways before forming a base and then eventually taking off. So what we're going to do is we're going to explore two different strategies that can allow you to trade both. So the first one we're going to explore here is a credit spread. So let's say I think the stock is going to move higher. So let's look at selling a credit spread. So I'm going to go out to September 24th. And what I'm going to do is I'm going to sell the 13.5 put, which gives me a downside risk that has fairly substantial downside risk and also takes a lot of capital in order to sell a put option. That's not what I want. So what I can do is I can buy a lower put against it. And what this gives me is a limited risk to reward strategy on Ford. And the difference between what I have to pay versus what I collect on the 13.5 put versus the 12.5 put that I buy, that is my net credit. And in a vertical spread, the distance between the two strikes, that's what you're playing with. And whatever you can potentially collect or whatever potentially you can make on that vertical spread, the rest of it is going to be your max risk. And this is really what makes vertical spreads fairly simple to understand, because the distance between the two strikes, in this particular case, the distance between 12.5 and 13.5, which is $1, that's what you're playing with, is $1 here for Ford stock. And whatever you can potentially make, the rest of that $1 is what you can potentially lose. So if I'm going to collect 67 cents to sell the 13.5 put, and then I pay 32 cents to buy the 12.5 put, that means my net credit is 35 cents. Now, each contract you buy or sell is always going to be 100 shares of the stock. So 35 cents multiplied by 100 means that the max reward on this trade is going to be $35. Now, because the distance between the two strikes is $1, if I subtract 35 cents from $1, the rest of it, the 65 cents, is going to be my max risk. So in this particular case, I'm risking $65 to potentially make 35. And this is a risk to reward ratio that many times when you first look at this at the first time, you think to yourself, why would anyone want to risk 65 cents to try to make 35? And that is a valid question. And it comes down to the fact that credit spreads are a very forgiving strategy. We're going to discuss that here in a second as to what that means, but you have a high probability of profit. As long as the stock stays above 13.5, the stock's currently at 13.71. I think the stock's going to go higher. But even if the stock goes a little bit lower, as long as it stays above 13.5, I'm going to be profitable. And that is the nature of selling a credit spread, is that you have a relatively high probability of profit in exchange for what is a relatively poor risk to reward. So again, not to say good or bad, it's just about understanding each strategy and what the pros and cons are, or rather what the trade-offs are with each strategy. Does that make sense? Please type 1 into the chat window if that makes sense to you. Now, if you've never heard of a credit spread before, I do have specific videos just on this alone that you can watch after today's session. And if you want to learn more about these strategies, this is more of an overview for each strategy. So credit spreads, higher probability of profit, worse risk to reward. On the flip side, when you look at debit spreads, Same example. Ford Motor, I think it's going to move higher here. So instead of selling the 13.5 put and buying the 12.5 put, which is a credit spread, let's look at buying a debit spread. I'm going to go out in this particular case to October, and I'm going to buy the $14 call option for 83 cents. But because I don't think the stock is going to go to infinity between now and October, what I'm going to do is I'm going to sell a $16 call against it and collect a little bit of premium. So instead of just paying 83 cents for the $14 call, I'm also going to collect 29 cents by selling the $16 call. And what that does is it caps my reward from unlimited to a certain amount. Because reality, I don't think the stock is going to 1,000 between now and October. I think perhaps it's going to reach $16 or $17. So why should I pay for all of it? So what you have here is instead of receiving a credit, you're going to pay a debit. That's why we call it a debit spread. So I'm paying 83 cents. I'm collecting 29 cents. That net debit here is 54 cents between those two numbers. So in this particular case, the distance between the two strikes between $14 and $16 is $2. Before, our credit spread was $1 wide. This debit spread that we're trading is $2 wide. And what we're doing is we're paying 54 cents for a $2 wide debit spread. And remember, whenever you're trading a vertical spread like this, whatever your max reward is, whatever your max risk is, the rest of is your max reward, or vice versa. So in this particular case, because I'm paying 54 cents for this particular trade, my max risk is just going to be $54. Now, when I subtract 54 cents from the $2, the rest of it, $1.46, that's going to be my max reward. So in this particular case, my max reward is 146. My max risk is only 54. So this risk reward ratio looks far better, right? And a lot of investors who look at risk reward from a risk reward perspective will say, wow, I want to trade a debit spread because I certainly only want to risk 54 to try to make 146. But there's a trade-off, just like in the credit spread where the high probability of profit was the trade-off here. The trade-off that we have with debit spreads is that with this great risk to reward ratio, you're going to have a lower probability of profit because the break-even point here is 14.5. The stock's currently at 1371, which means that the stock has to reach 14.5 just for this strategy to break even. So if the stock does rally up to 14.5, I'm actually not even profitable yet. I'm just breaking even. I have to believe the stock is going to exceed 14.5 before the strategy is going to be profitable. But if the stock does manage to reach $16, then what I do is I make $146 on the back of the $54 that I've risked. But that only happens if the stock does manage to reach $16. If it doesn't reach $16, then that's not the risk to reward that I receive. If it's less than 14.5, I'm actually going to lose money. If it's greater than 14.5, I'll be profitable, but only at $16 or higher do I make the 146 to 54 risk to reward ratio. So what we're trading off here with the debit spread is a lower probability of profit in exchange for a much better risk to reward ratio. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Okay, so just to summarize, whenever you buy a debit spread, you're generally going to see probability of profits that are in the 30 to 50% range. These are relatively low. When you trade debit spreads, you need to anticipate that you're actually going to lose money on at least half the trades. Usually about 60% of the trades on debit spreads, you're going to lose money. But the other 40% of the time that you do make money on a debit spread, you're generally going to make more than what you risked on the trades that you traded at a loss. So for example, if you lose $54 on one trade, lose $54 on the second trade, and the third trade, you make $120. The two trades that you've lost or the one trade that you're profitable on, you make more than the two trades previously that you lost. That's the nature, if you will, of debit spreads. And then on the credit spread side, it's the opposite. You generally will have higher probability of profits. We generally find 50 to 75% of your trades may be profitable, but the risk to reward is skewed against you, meaning you're going to win more often. You're going to win small call more often. And then less frequently you're going to lose, but when you lose, you're going to lose a larger amount, okay? So again, one strategy is not better than the other. If one was better, you would always trade the better strategy. It's a matter of understanding the two and understanding when you want to use each one. So let's talk a little bit about the optimal scenario. I'm going to go through the data to show you why this is the case. So first of all, I tend to find that when I ask this question from investors, and please, write this into the chat window. How do you go about deciding whether you want to trade a debit or credit spread? You can answer, what metrics you look at in the chat window. I know some investors like to use, someone said market, someone said credit, someone says IV, implied volatility. Someone says conviction equals debit. Bias for directional move, expect a big move for debit spreads. So great answers, great answers. So there's a few questions or a few answers using implied volatility. And this is usually the most common question that we receive, is that most investors will use implied volatility to decide whether they're going to sell a credit spread or buy a debit spread. And the general rule of thumb here is that if the implied volatility is high, you're better off selling a credit spread. If implied volatility is low, you're better off buying a debit spread. Now, while this in technical terms is correct that higher implied volatility conditions are better for selling credit spreads and lower volatility implied volatility environments are better for buying debit spreads, I think investors will be surprised at just how little implied volatility actually has of meaningful impact on your strategy. And there's something else that has a much bigger impact that most investors don't think about. And this is actually doing you a huge disservice if you're simply using implied volatility to select your option opportunities. What's far more important is actually your directional view. What I mean by this is I'm going to show you charts on the next slide, but generally speaking, when you expect a large expected move, so you think the stock has just recently broke a support level and you think it's going to fall apart, that's the type of catalyst that perhaps you might want to buy a debit spread for. If, let's say, earnings are coming up and you're expecting that the stock's going to make a big move and you have a directional view, that's when you want to use a debit spread. If, for example, you expect that the stock is just going to make a small directional move, you have a general sense for the trend, there's no catalyst on the horizon that you think is going to cause the stock to make a big move, that's when you want to sell a credit spread. So mild directional view for credit spreads, large expected view for debit spreads. Don't look at implied volatility. I'm going to show you on the next slide why that is the case. And certainly not just using IV rank, which is a generalization of volatility. It's not enough using IV rank to trade your option strategies. And the reason for this comes down to the actual option Greeks. So I have here on my chart on the screen two trades. This is the debit. This is the debit up here. The Greeks for the debits up here, and the Greeks for the credit, which is right here. So as you can see, here are the Greeks: delta, theta, vega, and gamma. Those are the four Greeks that I have up here. That gives you a sense for the exposure that you have with each one of these trades and what has the biggest impact on your option strategy. So look at these two strategies. Which Greek is largest on all of these strategies? Feel free to type the answer into the chat window. Which Greek here on these two strategies are the largest between the two? And I think most of us will quickly see that it's delta. Delta has the largest impact of your option. Delta here, as you can see, is 26. On the credit spread is 18. That means for every dollar Ford moves up, I'll make 26 cents on my debit spread. For every dollar that Ford moves up by, in this particular case, I will make $18, right? So this is really how you can think about what actually has the biggest impact on the value of the trades that you're making. Now, the second biggest Greek is going to be gamma. Gamma moves delta, right? Gamma tells you how much delta is going to move for every dollar that the stock moves up by. So delta tells you how much money you can make, and gamma tells you how much of that leverage is actually going to change. So what you immediately see is that between delta and gamma, this is really where you're going to have the biggest impact on the value of your option. If you look at theta and vega, which are certainly important, but notice how small these values are, that they actually barely show up. You're talking about 1 cent move in vega for every 1% change in implied volatility. And keep in mind, implied volatility is not something that moves a whole lot, right? So even with Ford, which has a relatively high implied volatility here in the 45% range, you're not going to see that move from 45 to 100. You're going to see that move from 45 to maybe 50 or 45 down to 40. So, a 5% implied volatility change is only going to have a 5-cent impact on your debit spread. It's actually going to have even less than 5-cent impact on your credit spread. So this just gives you a sense for how little implied volatility affects the value of your option. It's not saying it doesn't have an effect, but the effect is significantly lower than the effects that delta and gamma actually have on your trades. And it's important to understand the difference between delta and gamma for debit versus credit spreads, because when you're trading a debit spread, you're long delta and you're long gamma. When you're trading a credit spread, you're short delta and you're short gamma. So what that means is that as the debit spread works in your favor, deltas keeps getting larger and larger and larger. That's going to work in your favor. A credit spread, as the trade goes in your favor, delta gets lower and gamma moves delta even lower, closer to zero, because you're short delta. So because you have a negative delta and you're shorted, that means as the trade goes in your favor, delta is actually getting closer and closer to zero. And that's what gamma is changing. Because you're short gamma is going to keep decreasing delta until you get to zero. So unless in the other direction, delta will keep increasing until you get to 100 for each contract. So this is important to understand. And I know that this perhaps is a little too much for some of you that are brand new to these strategies. So I do encourage you to learn more about the Greeks before you come back to this. But this is a reference to you that when you're long, when you're long a debit spread, you're long delta and you're long gamma. You're also long theta and you're also long vega. So whenever you're trading a debit spread, you're basically long all these Greeks. But remember, the most important thing is that delta and gamma are the ones that you have the biggest exposure to. Theta is important, but the net delta between being long theta and short theta, as you can see, is a relatively small amount. And this is part of why we trade debit and credit spreads, is that we can lessen the effect of time decay on our trades. We can basically have a relatively large delta exposure with a relatively small theta exposure. So we don't have a lot of time premium working in our favor. We also don't have a lot of time premium working against us. We kind of have a fairly pure delta exposure. It's just a matter of whether this delta gets larger and larger as we're right, or if a delta gets smaller and smaller as we're right. And vega, like I said, relatively low impact. So then begs the question, why do traders trade credit spreads far more often than debit spreads? And it really comes down to nothing other than directional view. Because as you clearly see, directional view is far more important, or has far more of an impact on your P&L than vega and theta. So time decay and changes in implied volatility have relatively small influences on your credit or debit spread, but the change in the directional view or change in the stock price will have a much, much larger impact. So when you think about credit spreads, because of the negative risk reward ratio, you're looking for basically higher probability trades. You're looking for trades that are more neutral. You're looking for trades that you have a mild directional view on. So as you look for a stock that's perhaps trading in a range, whether this is a horizontal range or a range that's starting to trend higher here, but you generally want to find stocks that are trading near the top end of the range, the bottom of the range, and you're looking for these opportunities to basically look for reversals, if you will, right? And whenever you find these reversal points, these are your opportunities to enter a credit spread or a debit spread and vice versa. And notice how often I'm able to find these opportunities on this chart versus when it's best to use a debit spread is when you're expecting a big move in the underlying stock. So here is a stock that has been range bound for a long time between 200 and between 185 and 225. It's been in this trend for about 6 months or so, and it finally breaks out. Now here is an opportunity to trade a debit spread, but notice how infrequently an opportunity like that comes along versus the number of times that I can trade reversals like this. And if you see that, it really has nothing to do with why one strategy is better or the other. It really just comes down to how frequently can you find opportunities to sell a credit spread and how frequently can you find opportunities to buy a debit spread. And the reality is that the opportunities to sell credit spreads comes far more often than the opportunities to buy a debit spread. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So nothing to do with whether a strategy is better than the other. It's just a matter of when you are able to find opportunities to do this. And for those of you that follow us here with the daily plays, that's why you tend to see us sell credit spreads more often than buying debit spreads. It's just that you don't find opportunities to where you think the stock is going to make a big move very often. You have to really seek that out, and it doesn't happen very often. But when they do, debit spreads are far better at capturing those big moves. And we're going to take a look at some of those. So let's actually, why don't we do this? Let's look at OptionsPlay right now, just to look at a few examples, because I do want to show you this. It's best to learn this side by side. So here's the Ford example, right? Let's say I think this Ford is going to move back up to maybe $16. So there's two scenarios. One, I think the Ford can maybe just move sideways and hold this support level and keep moving sideways here. Another one is I think the stock's going to make a big move up to $16. Each one of us may have different views. I don't particularly have a strong view here on Ford per se, but I want to look at both and show you how you can decide which strategy is best suited for you. So I have both. I have the credit spread set up as I was showing you here before, and I have the debit spread right here on the right-hand side. Credit spread on the left, debit spread on the right-hand side. Now, one of the things that you want to do is use the P&L simulator. And I always encourage investors, before you use the P&L simulator, use the risk and investment calculator. Calculate how much you're willing to risk on a trade. Let's say you're willing to risk, I don't know, $500 on this trade, right? What it does is it calculates for you, number one, the appropriate number of contracts. So I can sell 7 contracts of the credit spread. I can buy 9 contracts of the debit spread. And what that does is it compares apples to apples, because here I'm risking $455. Here I'm risking $486, which is within the $500 tolerance of what I want to risk. You always want to do this first if possible. And then you can then look at, what happens if the stock stays where it is? What happens if it goes higher? But you always want to first look at how much, if the trade doesn't go in the direction that you expect it to. Now, the great thing about using the risk and investment calculator is that you don't have to do that actually, because if the trade doesn't go in my favor, the most I can lose is roughly $500, or here in this particular case, $455 or $486. Now, the next thing I want to look at is what happens if the trade goes in the direction that I expect it to? Well, that depends on what your views are, right? So your view could be simply, it's back near a support level. I'm not convinced it's going to rally to $16, but I'm fairly convinced that it's not going to break through this support level. I think it's just going to hold this level and trade sideways, right? So if you think that's going to happen, you can say, what happens if the stock stays at about $14 or so? As you can see here, you make $245. Great outcome for the stock not moving. Debit spread, guess what? That doesn't work out very well. You lose $486. So nothing to do with implied volatility. And if you use implied volatility to do this, you may be pleasantly surprised that you have lost money on this particular trade, because now you're down $486 because, despite the fact that implied volatilities were low, doesn't change the fact that the stock needs to move a whole lot before the strategy is profitable. And then you can then start taking a look at, well, what happens if the stock starts moving higher here, right? And as you can see here, the break-even point's 1454. That's my break-even point, 1454. So at 1454, so if the stock rallies a little bit to about here, then here I make $245. Here I still make nothing. Right. So you have to ask yourself, do I think the stock's going to get back above 1454? And if the answer is yes, then you can take a look at, well, does it make sense? Because it's only until about 1484 do the two strategies start to be similar, right? So the stock has to reach 1484, which is all the way up here, which is the next support level here, 1484. If it reaches 1484, the two strategies are actually very similar to each other. 245 versus 270. Now, if the stock exceeds 1484 and gets up to 1579, $16 or so, that's when things really turn around, right? Here, I'm only still going to make $245. That's the extent of what you can make on a credit spread. There's a limit as to how much money you can make, but you can make money in a lot of different scenarios, right? The stock stays where it is, the stock moves lower, the stock moves higher. You make money in all of those scenarios. But a debit spread, you don't make money in most scenarios, but when you do get it right, especially when you get a big directional view right, notice how much further you outperform the two strategies. So similar amount of risk. One, I make 245. One, I make roughly more than five times that, $1,300. So this is really where, how the two strategies could not be more different than each other. And it's so important for investors to truly understand the differences between the two strategies and use our P&L simulator and compare the two strategies based on different outcomes to decide which one's best suited for you. It's not always best that you trade debit spreads, not always best that you sell credit spreads. It's just that you tend to find opportunities for credit spreads more often than you find opportunities for debit spreads, because it's not every day that you think the stock is going to rally, what is effectively more than 10% here over the next couple of months, right? So hopefully that makes it a little easier for you to understand how to use our platform to compare the two strategies side by side. So let's talk a little bit about, once you're in these types of strategies, how do you manage them? So with credit spreads, it gets a little bit more complex than debit spreads. So why don't I cover debit spreads first, because it's easier. Debit spreads, you simply look at how much you paid for the debit spread, and you either cut your losses at 50% of what you paid, or you take profits at about 75 to 100% of the premium that you've paid. So if you pay $3 for a debit spread, you want to cut your losses once it reaches about $1.50. Once you've lost 50%, cut your losses, keep that $1.50 for the next trade. Don't hope, if you will, because once a debit spread loses about 50% of its value, you've largely only have about a 15 to 20% chance of ever breaking even on that trade. So you're better off keeping that $1.50 for the next trade, rather than hoping for that 15 to 20% chance that you do get back to break even. Now, if the trade starts to go in your favor, once that $3 debit spread that you paid for reaches about $5.25 to $6 in that particular range, now it's time to start thinking about taking profits. Now, taking profits means two things. One, if you think the stock can keep moving, you don't have to just take profits. You can take profits and then open up a new debit spread. This way, you are playing with house money, if you will, right? Meaning you can take the profits that you've made on this particular case, in this particular trade, and buy a new debit spread. And this way, you are not, whatever particular gains you get going forward, you are not risking your own money in order to place that bet anymore, because you've rolled your profits from the first trade into the second trade. I get a lot of questions from investors saying, what about losing trades? My philosophy on this, and I'll cover this a little bit more next week, is that cut your losers. Don't just move on to the next trade. I see too many investors that spend way too much focusing their attention on losers, not enough attention on their winners. And the best case scenario in a losing trade is that you get yourself back to break even. versus a winning trade, you can really hit some huge home runs if you focus your attention on rolling your winners rather than your losers. So cut your losers, focus on rolling your winners. And then when it comes to credit spreads, this is really where it gets a little bit more complex. There are 3 possible rules to exit this trade, and it's based on how much you collect. So if let's say you sell a $5 wide credit spread and you're collecting $2 of it, right? So $2 out of a $5 wide credit spread. You want to exit at a profit when you've made 50% of the max gain. You want to exit at a loss at 100% of the max gain. Or if the stock reaches 21 days to expiration without triggering the stop loss or the take profit, it's time to cut your losses. It's time to simply get out of the trade. It doesn't matter whether you're a gain or a loss, it's time to get out of the trade. So when we talk about a $5 wide credit spread for $2, that means if you sell something for $2 and it's now trading for $1, if you sold something for $2 and it's now trading at $1, you've made half of what you can potentially make. So that's where you want to take your profits and move on to the next trade. Now, if you sold something for $2 and it now increases in value to $4, that means you've lost $2 or 100% of your max gain. That is the time to take your losses on the trade. And then lastly, like I said, if it gets to 21 days to expiration, and it hasn't reached $1 and it hasn't increased to $4, then it's also time to get out of the trade. You don't want to hold the credit spread in the last 3 weeks of the trade. So those are the rules for selling a credit spread. It's a little bit more complex, but those are the rules that can help you stay out of trouble. So with both of these strategies, the most important thing with even if you follow all the strategies that we discuss here today, the most important thing, and this is something I'm going to get into a little bit more next week, because this is arguably the most important thing, is that whenever you're trading these types of strategies, you want to make sure that the max risk of the trade does not exceed 1 to 2% of your total account value. And that's what the tool here with OptionsPlay, the risk and investment calculator, is designed to do. So no matter what type of strategy you're trading, whether you're trading Ford, you're trading Peloton, it doesn't matter what stock you choose. Whatever strategy you choose, whether you're trading a debit spread or you're trading a credit spread, I'll just set up a credit spread here real quick for everyone to look at. So if we sold the 120, 105 credit spread, whenever you look at any strategy side by side, I always encourage investors to use the risk and investment calculator, which is the 3rd button here from the left. And I usually like to use the I want to risk button because it tells me absolutely how much I have at risk. So if let's say 2% of my account is $2,000, let's say you have a $100,000 portfolio, 2% of that is $2,000. You can plug that into this trade, into this calculator. It will calculate for you the appropriate number of contracts that you can trade, so that when you compare strategies side by side, when you look at debit versus credit spreads, both of these strategies will risk just shy of $2,000. So you can know I'm comparing apples to apples. So when you use the P&L simulator and you look at how much can I potentially lose versus how much can I potentially make, you're comparing strategies that are realistic for your risk profile. Always make sure that you stay in your lane, because that's going to help you stay out of trouble. And I'm going to talk about quite a bit next week what the rules are for staying out of trouble and why retail investors get themselves into trouble so often. And it really has nothing to do with your strategy, has nothing to do with what indicators you use or who you follow. Retail traders get themselves into trouble because they have a misunderstanding of statistics, in my opinion. They have a misunderstanding as to what are the chances of losing. Even though we think that we have a good understanding of it, I tend to find that most investors really have a poor understanding of it. So I really want to dive into that next week. So I really hope many of you are able to join me next week on what I think is one of the most important lessons for retail traders to learn. And then lastly, for those of you looking for credit spread opportunities, this is really where our opportunity report gives you all of these possibilities. It gives you a potential symbol versus direction. We tell you exactly which strikes to buy and sell. We give you the risk and reward of each strategy. So for credit spreads, we try to collect as much premium as possible because that's going to reduce our risk. You also have volatility and earnings. And we recently just launched this new link that will allow you to analyze a trade directly in OptionsPlay OptionsPlay. So if you're looking at our OptionsPlay hub, which many of you are using as your tools to help you scan for opportunities and look at our reports. One of the reports that we have on there is the credit spread opportunity report, which I will bring up here in 1 second. And this is a report that now has a direct trade link to OptionsPlay. So if you're looking at this report, the credit spread opportunity report, what we have here are now direct trade links. So if you're looking at an opportunity in options in our credit spread report, you can click on the link and it will bring up the exact trade in OptionsPlay so that you can instantly look for the opportunities and measure the risk to reward ratio, maybe compare it to a debit spread, maybe compare it to buying the stock, maybe compare it to buying a call option, whatever it is. What we're trying to do is find you opportunities where the risk to reward is maximized versus the probability of profit. This way you can really find opportunities here in the broader markets. That's now all included inside of your credit spread opportunity report, which is found on your OptionsPlay hub, which is available at optionsplay.com/hub. Or if you just click on the education or resources section on the top of your screen, you'll be able to access that here as well. And that report is updated intraday every single hour. So just to summarize what we discussed here today, when we talk about debit versus credit spreads, there is a trade-off with each strategy. One is not better than the other, and the trade-offs are between probability and risk to reward. You're never going to be able to find something that's high probability and high risk to reward. You always have to choose between the other between one or the other. So it's just a matter of understanding whether you think the stock's going to make a big move or not, or you think the stock's going to make a small move. Because if you think it's going to make a big move, it's far more efficient for the same amount of risk you're going to take. You're going to get far more return on a debit spread than you are going to be on a credit spread. But if the stock doesn't move big enough, guess what? You can lose money even if you get the directional view right. So that's where a credit spread comes into play. If you have a mild directional view, you don't think the stock's going to make a big move, selling that credit spread is going to be better. And I do think that in order to get an edge, you really have to start to learn how to read a chart. For those of you that are technical analysts, this is really where charting can really help you on timing and direction, giving you a good sense for the overall trend, giving you a sense for the timing of that overall trend. That's going to help you improve your trades and improve your probability of profit. And I always encourage investors, practice, practice, practice. You can paper trade these strategies using OptionsPlay. If you don't know how to do that, find our paper trading video on YouTube. It'll show you how you can take a credit spread, a debit spread, trade the two side by side, see how they actually perform with different stocks that you have a view on. And as you trade and practice this over a period of time, that's how you're going to be able to learn how to utilize these strategies and learn which one's best suited for your portfolio. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of these two strategies and why, despite the fact that one is far more frequently traded than the other one, that one is not better than the other, that you really have to consider the different scenarios that specifically regarding directional views that really should be dictating which one of these two strategies you trade. So with that, what I'll do here is I'll open this up for Q&A. There's a Q&A section here at the bottom of your screen. If you have typed into the chat window, please type your questions into the Q&A section, and I'll try to answer as many questions I have time for today. I see a couple of questions. William's asking, can we provide screens for debit spreads? Well, William, the hardest part about a debit spread is not finding the opportunities, finding the debit spreads, screens like this. That's easy to do. What's much harder to do is to screen for stocks that are going to do this. And that's really where it's impossible to just screen for stocks that are going to do this, because stocks do that very rarely. So that's really why, we don't have a debit spread screen, because if debit spreads are really cheap here, guess what? It's not really useful to you if you don't think the stock's going to make a big move. So we can find cheap debit spreads all the time, but that doesn't mean the market conditions are right for trading them. So that's why we do not provide a debit spread screen. Let's see. When to place a call spread versus a put spread. So those are based on directional views. Those are not based on debit versus credit. So if you have a bullish view, you would trade So just to be clear, a call debit is for bullish. A call, whoops, let's do this. Call debit, call credit, put debit, and put credit, right? So call debit is for bullish, call debit is for bullish, call credit is for bearish, put debit is for bearish, and put credit is for bullish. So that's how you can think about which one is suited for you, whether it's a call or put, and whether it's a debit or credit. So the debits really follow the convention of the call and the put, and the credits is basically the opposite. So a call credit is bearish, a put credit is bullish. Can you please go over once again how we should use the risk tool when we need to hit I'm bullish, I'm bearish first? Do we need to hit I'm bullish, I'm bearish first? You always should hit I'm bullish and I'm bearish first. So, that's why I'm bullish and I'm bearish on your screen is on this screen, right? Because the whole platform is you move from left to right, right? So you look at ideas, watch list, your portfolio, you move into the security selection. From the security selection, you either say I'm bullish and you want to look at 3 bullish strategies, or you say I'm bearish and you look at 3 bearish strategies, right? So you always look at I'm bullish, I'm bearish first, then you set up your strategies, and then you look at your risk and investment calculator. So you kind of move like left to right and then top to bottom. Why sell out of a debit spread at 100% profit and open a new credit spread as opposed to just selling half your contracts? So, Matt, there are many, many ways that you can adjust a winning position. Certainly, selling half your position is one way that you can do that. I actually have a separate video just on that alone. So you have a lot of options as a profitable trader as to how you can adjust your positions. You can close half your position, you can roll them up, you can roll them out. There are so many different options that you have at your disposal. When you're losing, that's really where you don't have a lot of options. And most options are just simply risking more money to try to get yourself back to break even. And those are really bad positions to put yourself in. So Matt, you're absolutely right. You can simply sell half your position, but I'm not suggesting that you sell out of a debit spread and then open up a credit spread. I'm saying sell out of your debit spread and open up a new debit spread. That's what I was suggesting. Why exit the trade 21 days from expiration? Really good question. The question is around credit spreads. Why do we have this rule of exiting the trade at 21 days to expiration? This comes down to the fact that there are 2 other factors working at play when you're selling a credit spread as you get closer and closer to expiration, and that's theta and gamma. And what happens is that as you get closer and closer to expiration, theta starts to accelerate, and that's good for your strategy on a credit spread. But what also accelerates is gamma. And what you're trying to figure out is when those 2 things will kind of cross over, where the acceleration in theta that's working in your favor offsets the acceleration in gamma. And at 21 days is where we find that crossover happens, where the acceleration that you get in theta is largely more than offset by the risk, the additional risk that you now have to take because gamma is so much larger. So that's why we close out trades at 21 days to expiration. The second reason is to avoid early assignment. When you sell a credit spread, you have risk of early assignment, which means that you will need to be long or short 100 shares of the stock for every contract that you sold. And that is something that you generally want to avoid. And one way you can avoid that is by simply closing out your credit spreads 21 days from expiration. And the next question is, what about risk of assignment with credit spreads? Well, if you follow these rules in place, these 3 rules, you will see almost 0 early expirations, or assignments on a credit spread. These profit or loss numbers appear to happen only if you hold the trade to expiration. My question is, how many traders hold these contracts to expiration? You're absolutely right. I'm was showing you based on expiration. You can simply use our credit spreads. You can use our trades and see how they actually perform prior to expiration here as well. So you don't have to certainly hold them to expiration. I was showing it to you based on expiration, but these are the things that you can model using our P&L simulator. Same rules for index trades, over 20 VIX high vol. Philippe, I'm not sure that I understand your question in terms of having trader status and you need to have a minimum amount of trades to maintain that status. Is that for your brokerage firm? I'm not sure I understand that question. Will the strategy be the same for naked options? No, selling naked options would be quite different from this. I do have, videos on buying and selling naked options as well, but the rules are quite different. In comparison of the spreads, how much should pop play in a strong role in choosing the spread? Pop, you should never look at risk reward ratio or pops separately. If you're looking at them separately, you're missing the other half of the picture. You always want to look at the combination of the two, right? And that's part of why we created the credit spread, because the credit spread is looking at the combination of the two and trying to find opportunities that are give you some form of an edge, looking at both risk reward and probability of profit. So never look at just one. If you're looking at one, then you're missing half the picture. How much does gamma affect options on the day of expiration? Well, gamma is highest on the day of expiration. Highest at expiration, and especially if you're near the money, meaning if you have a strike price that's close to the current price of the stock. If you have very high delta, then your gamma is virtually zero. If your gamma is close to zero, if your delta is close to 0 or 1 at expiration, then gamma is virtually zero. Gamma is highest when you have a delta closest to 50. When your delta is 50, then that's when gamma is highest. So if you have a very high delta at expiration, then you don't have to worry so much about gamma. Do you typically have twice the width on a debit than credit? No, not necessarily. That's just how it played out here for Ford. You generally do have a slightly wider debit than you do on a credit, but that's more of a volatility-based thing. That's not necessarily a rule of thumb by any means. Do you consider the direction of the market when you decide which spread to put on? Mark, I hope that today's session really just showed you that that's the only thing that you should focus on, because direction is what has the largest impact on the value of your option. Between delta and gamma, these values are far, far larger than theta and vega. Theta and vega have very small values. They have very little impact on the value of the change of your option. Direction is everything. So absolutely, direction is first and foremost on all of these trades. You mentioned that we are to exit credit spreads 21 days to expiration, but doesn't most of the premium come in the weeks and days leading up to expiration? No, Aaron, you will generally tend to find that when the trade goes in your favor, you will actually make it prior to 21 days to expiration. Some of those strategies, unless you're selling really far out of the money credit spreads, which we do not recommend as well. So, we have optimal credit spreads where you generally do not have to wait till 21 days to expiration. It's actually rare that we exit a credit spread because of 21 days to expiration without hitting stop loss and take profits. Some of those strategies show a cost of, let's say, 185 and a max reward of 185. Why bother? That's like saying, why bother buying a stock? It's not, here's the thing, one is not better than the other. Hopefully today's lesson shows you that high probability is not better than low probability because of the trade-offs. So if you have something with 185, that means you have a 50-50 shot, right? So if you think that you have a strong directional view and you have a 50-50 shot of making 185 versus losing 185, and you think that you have an edge on timing the markets of directional view, why not take that trade? There's nothing wrong with taking that type of trade. What would have happened to Ford if we use the same strikes on a call as a debit spread is used for the put spread? You should never, ever use the same strike prices on a debit spread as a credit spread. Those are two very different things. So the question was, I'll show you what happens. I mean, in theory, nothing happens. The two are identical because of put call parity. Whether you trade a debit or a credit, if you choose the exact same one, you will have the exact same outcome. So let's show you this. So these two, this is a credit on the left-hand side using the exact same strike price and expiration as the debit spread. As you can see, the two are identical. Max risk, almost identical. Max reward, almost identical. The difference between these two pretty much come down to the bid-ask price between the call and the put. However, the reason that you should never trade a credit spread as a debit or debit spread as a credit is because here now I've sold the $16 put. I've sold the put option that's about $2.50 in the money. So even though you have the exact same outcome as a debit spread, you have far more early exercise risk, early expiration risk. So I'm sorry, early assignment risk. So that's why never ever trade a credit spread as a debit or vice versa. But in theory, the two have the exact same outcome because of put call parity. If you're on this webinar, you will receive the recording along with the slides. I have two portfolios, one slanted towards growth stocks, the other towards value or income stocks. Would you limit open trades to 5 trades total or 5 in each account? I would say 5 in each account because you're trading them separately. What's the best technical setup for a bullish trigger, i.e. 5? So Kevin, there are infinite technical setups. I mean, if one was really better than the other, I promise you, everyone would trade that. We've done a lot of technical analysis back testing. You can get the technical analysis back test from us, the report that we have, and take a look at the indicators. But there are literally infinite number of indicators that you can use with different triggers. So there's no way to test it all. We can only test the popular ones and give you a sense for the the performance that we have seen. For bull puts, you say take 50% profit. Will you be providing the exit signals? So we always send you for daily plays our exit signals based on the rules that we place for you on these webinars. Would a debit spread work better with in the money calls opposed to out of the money calls? No, not at all. I'm not even sure what you mean by selling an in the money call, like something like this. I mean, you have the same problem here, right? If you trade it as a debit versus a credit, is that you're going to have this, you have the same risk reward. There's whether you interchange debit or credit, if you use the same strike prices, you're going to get the exact same results. The only thing is that if you trade the opposite, you're going to have far more early assignment risk. So that's why you don't want to use this. You don't want to swap deltas. Debits with credits. Donald, you can send us an email at info@optionsplay.com. Happy to help you out, or simply just when you're on the platform, click on this question, ask us button, and we can try to help you with that. If VIX or IV is high, which strategy is best? So Chuck, I hope that I was showing you here that IV has a relatively low impact on your strategy. Look at how small Vega is in comparison to Delta. So in theory, low IV is better for buying, high IV is better for selling. But with vertical spreads, you're buying and selling, which is why the two largely offset each other. If you're trading naked options, then yes, implied volatility has a much bigger factor, but you also have bigger delta and gamma when you're trading single leg options as well. So you really have to think about the ratio, if you will, of implied volatility exposure to delta exposure that you have. That's how you decide whether you use delta to choose, your options, or whether you use volatility to choose your options. Why doesn't OptionsPlay show credit spread ideas? We do a lot of credit spread ideas. Our whole credit spread report is designed to only show you credit spread ideas. And we scan for the best credit spread ideas for you here. Why would you have, do you have video on rolling up or down? Yes, we do. If you go on our YouTube channel, I have one specifically on managing winners, and I talk about rolling up or down. Donald, please send us an email at info@optionsplay.com. I'm happy to have our team help you out with that. Is it desirable to sell an in-the-money debit spread? Well, there's no benefit to selling an in-the-money debit spread. You have the exact same risk-reward ratio as selling an out-of-the-money credit spread, and you don't have the assignment risk that you do when you do an in-the-money debit spread. So do not do an in-the-money debit spread. Do not do an in-the-money credit spread. I'm sorry. Do not trade an out-of-the-money debit spread, and do not trade an in-the-money credit spread. What's your rule of thumb for delta choices for debit and credit spreads? So this is something I cover in both of my videos on debit and credit spreads. But whenever we're selling a credit spread, we sell the 50 delta and we buy the 25 delta for credit spreads. And then for debit spreads, we buy the 50 delta and we sell the 20 delta. So very similar deltas, but slightly different between the two. I have 1 more minute to answer a few questions. Let's see, what else do we have here? Can we put condition to a broker that I would not like to have assignment at all? No, because as an option seller, you're taking on that obligation. You can't just say, I want the money for it, but I don't want to take on the obligation. So as an option seller, you have to take on the obligation. What flexibility is there in that 21-day rule? Well, David, I would say that you have some flexibility within a few business days. So, I think that the lowest end of that threshold is about 14 days. But here's the thing, it's not about which day you choose to use, right? If you want to use, I use 21 days because that's what the data shows you. If you want to use 17 instead, you can. But the reason that we use a single number is because you want to be as mechanical as possible with this. You don't want to have a lot of discretion. It's not to say that you can't have discretion, but the more discretion that you have in your rules, the less likely you're going to have a trading system, if you will. If you're always flexible on your rules, you're just going to have inconsistent results. So the reason that we want to have less flexibility in our trading is so that we have more consistent results. The more flexible you are, the less consistent you're going to be. So with that, hopefully this helps you to give you that better understanding of debit versus credit spreads and an understanding as to why the directional view is far more important in choosing which strategy you use over volatility. I see too many investors use volatility to decide whether to trade debit and credit, not knowing just how much potential profits they may be leaving on the table when they're trading, debit versus credit spreads, or what opportunities they're giving up by choosing one or the other. So hopefully you're able to now use the platform to analyze the two side by side, make sure that you understand the risk for rewards in order to help you make your trading decisions. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here tomorrow morning on our rapid fire session. Really excited to do another session. You guys have submitted a lot of symbols where me and my research team are already putting together our notes for it. Really looking forward to sharing that with you tomorrow morning for our members. Thank you so much. Have a great night.